Okay, so are we live? Good afternoon, ladies and gentlemen. I hope you are all doing well. My name is Joseph from 100 Conferences. For people who are not familiar with us, we are a European private equity and venture capital platform, already more than 5 years on the market, and we are connecting private equity professionals all over Europe. For more information, visit our website, 100conferences.com. I would like to welcome you all at our third session from our webinar series, today with the topic COVID-19 impact on the VC market. I would like to encourage you to get interactive. On the right side of the window, you can chat, ask questions, and vote in polls. And in the email which you will receive at the end of the webinar, you will get a link where you can download the presentation from Preqin. I would like to thank the media partners of the webinar, Preqin, IPE, CE Legal Matters, CAIA, and Savvy Investor, and all other partners and associations. You can pre-register for our latest product. It's called InvestBridge, which provides a detailed database of more than 6,000 LP contacts. You can find more info on the website 100investbridge.com. You will also get this information in the email. You are also invited to join our virtual conference, which will take place on 25th of June. Again, we'll provide more information somewhere else. And now, without further ado, I would like to hand over the word to Patrick Sheehan from ETF Partners. Patrick, please take it from here.
Hi, and welcome everybody. I think we'll have a pretty lively time, and this is going to be as conversational as we can make it. We will start off with a roughly 10-minute introductory presentation we're lucky enough to have from Thomas Mulready of Preqin. And that'll be setting the scene for us and maybe suggesting a few question areas. I'm the moderator, so my job is easy, but I have a great three panelists to ask difficult questions to. They're all looking forward to it. So Thomas, without much more delay, I'm going to pass over to you to get us going.
Yep, sure. Okay. Well, hello everyone. My name is Thomas Moradi. I'm head of private capital deals for the EMEA regions at Preqin. It's a pleasure to partner today with 100 Conferences and take part in this series of webinars. And I hope you all enjoy the event today. Today, I'm going to take a look at some of the latest Preqin data to draw out some insight into how the venture capital industry is reacting to COVID-19 and what is likely to come in the rest of 2020 and beyond. I hope you find it interesting, and my contact details are included on a slide at the end, so please reach out during the event and after the event if you have any questions. So just before I begin, just for those who may not have heard of Preqin, I'll give you a quick introduction. Preqin is a global leader in data and research for the alternative assets industry, and we cover everything from investor appetite to fundraising, performance, and deal flow. Our team spans 13 global offices currently, and our focus is on engaging with investors, fund managers, and service providers to better understand their activities within this space, all to provide our customers the highest quality data to help them with their investment decisions. So just in terms of the agenda today, as we enter the later stages of COVID-19, there obviously still remains a lot of unknowns regarding the future fallout from the current situation. Despite this, Preqin in a unique position to get a view into what the market is likely to be across the venture capital market and what the recovery might look like in the future. But before I do that, I do want to spend a few moments just setting the scene, as it's important to understand how the venture capital market looked like prior to the outbreak. So as we know, the venture capital industry has been experiencing unprecedented growth and has played a key role in getting businesses off the ground, providing entrepreneurs with ongoing business advice and support, and contributing to local and national economies, as well as launching world-changing technologies. To put a value on this growth, AUM, which measures both dry powder and capital put to work within the industry, has more than doubled over the past 5 years, and in 2019 reached a record high of $1 trillion, and further growth is expected. In our Future of Alternatives report in 2018, we made a conservative prediction that AUM within the whole of the alternative assets industry would reach 14 trillion by 2023. The industry is already outpacing that projected growth rate and running approximately 12 months ahead of schedule. And we expect venture capital to grow substantially along with the rest of the alternatives industry. And this growth in AUM has largely been fueled by record levels of capital that has been flowing into the space over recent years. Between 2016 and 2018, venture fundraising surpassed $100 billion. There was a dip in 2019 where it fell just below the 100 billion mark for the first time in 3 years. However, the decrease is not overly significant when you consider that capital inflows in 2019 were still higher than all the years preceding 2016. And if we break this down further to venture strategies, we can see that generalist venture funds draw in the biggest proportion of investor capital. These fund types allow investors to diversify their risk and gain access across the various fundraising stages. And one of the major draws for these types of VC funds is the return profiles that they offer. However, in 2019, the proportion of capital flowing into venture general funds shrunk to its smallest proportion since 2013. And early stage strategies saw its biggest proportional increase since 2013. Expansion and late stage funds also saw an increase. The performance of these strategies, as we will see in the next few slides, is probably influencing investor appetite for these fund types. And of course, at the heart of the overall growth of the industry is investor demand. As you can see on the left here, portfolio diversification is a key driver across every asset class, as investors continue to spread their exposure across uncorrelated markets in search of yield. In addition, fund performance and the ability to deliver attractive risk-adjusted returns keeps investors coming back for more. If you look at venture capital performance specifically over a 10-year horizon, venture capital has consistently delivered around 11 to 12% returns for investors. In comparison to other strategies, returns have been lower over the same time period. However, over the 1 year horizon, venture capital funds match buyout and outperformed fund-of-fund strategies. Further to this, the opportunity to earn higher absolute returns is another key driver. This is particularly noticeable amongst PE strategies, which includes VC. And just to delve a little deeper into performance, if we break this down further by venture strategy, and as I mentioned in the previous slide, performance is the key driver when selecting a fund. And early stage and expansion late stage funds have generally outperformed venture general funds. Expansion late stage has also saw the largest increase over Q3 2019 with 11.1% returned. While early stage funds do see investors take on the highest risk, as can be seen on the right, early stage has provided higher returns over time compared to other venture capital strategies. So investment in early fundraising rounds is profitable as long as the risk of these funds types is obviously managed correctly. And investors as well are generally satisfied with the performance they are seeing. As you can see on the left here, over 80% of investors we surveyed in November 2019 told us performance had either met or exceeded their expectations during the year across most asset classes. Private equity, which included VC for the purposes of the survey, had the biggest proportion of respondents who said returns had met their expectations. However, a lot has clearly changed in the world since November 2019, and while the vast majority of investors expected this strong performance to continue in 2019, it seems inevitable that these expectations will need to be revised in a post-COVID-19 world, and we will dive into that into the next section. But before we do that, it's probably worth highlighting the levels of confidence had in alternative assets, which includes venture capital going into 2020. Pretty much across the board, over 80% of investors were planning to invest either the same amount or more capital in the year ahead versus 2019, yet again demonstrating the faith investors have in the space to keep delivering against portfolio expectations. However, we will continue to monitor investor sentiment closely in light of changing market conditions. And yes, there are challenges ahead, but the longer term growth potential across venture capital very much remains. So that is how the alternatives and venture market stood prior to the outbreak of COVID-19. However, the world clearly feels like a very different place now than it did a few months ago. Preqin has been speaking with hundreds of investors and fund managers and analysing our own data to get an early view into what is happening across the market and how the outlook may have changed. Before we look at the impact of venture capital, it's probably good to draw a comparison with how the rest of the private capital market has been affected. Looking at Q1 fundraising results, there are clear signs of contraction across private capital. Global fundraising was down 30% globally in Q1, the lowest quarter since Q1 2018, and the fewest number of funds to reach a final close for 7 years. All regions and strategies were impacted, although not surprisingly, Asia was the worst hit. Fundraising across Asia was down 66% in Q1 due to having restrictions in place much earlier, while fundraising in Europe and North America was also down as the pandemic took hold in the West. Buyout fundraising was down 53% in Q4, on Q4 2019 levels, and private debt was down 62%. Although interestingly, venture capital had a very successful fundraising quarter, with VC managers securing over 30 billion globally. Looking at early Q2 figures, just over 164 billion has been raised across private capital so far, which looks set to be one of the worst fundraising quarters on record. You would need to go all the way back to Q3 2014 to find a worse fundraising quarter. Now, if we just take a deeper look at venture capital itself, in Q1 2020, as we've said, 38 billion in capital was raised, the largest amount of capital raised since Q3 2016. Much of this capital went to North America-based managers, with two notable fund closures, Tiger Global Private Investment Partners and New Enterprise Associates, that raised almost 7 billion between them. However, so far in Q2, fundraising has declined steeply to 17.5 billion, with the pandemic now taking hold across Europe and North America. Asia also continues to suffer despite being ahead in tackling the virus, with fundraising down almost 50% on Q2 2020. This is also reflected in the number of funds closed in Q2, the worst recorded quarter on record when measured against the same period in 2019, with Asia again being the worst affected. So fund managers have been met with difficult and uncertain fundraising environment, with many LPs choosing to delay allocations until they can see some level of recovery within the space. And deal activity has also taken a hit. So in Q2, the number of deals dropped by 39% when compared to the same time frame in 2019. Q2 has also been the worst quarter on record for venture deal activity, and falling since the start of the pandemic in Q4, which has also resulted in managers delaying capital allocations and putting their deals pipelines on hold for the foreseeable future. Social distancing has also placed restrictions on managers meeting with key stakeholders, which could also continue to affect future deal flow, as it will most likely remain in place for a while yet. But this is not to say managers haven't found opportunities to put capital to work, as the next slide will show. Aggregate venture deal value has also fallen again in Q2. However, as can be seen, this has by no means been the worst quarter in terms of value of deals closed. While aggregated deal size has been down across Europe and North America, it was negligible across Asia, where it's fallen less than 1% when measured against the same time frame in 2019. On a more positive note though, deal value actually increased by 21% in Asia compared to Q1 by 21% in Asia in Q2 when compared to Q1 2020. And there has been a 6% increase in the number of deals completed, which may be an early indication that deal-making activity could be returning to some semblance of normality in the region. But despite the adverse conditions, managers are, my previous slide, managers have found opportunities to put capital to work in certain sectors. And health tech is one of those areas. Venture-backed health tech deals have soared, highlighting a key trend that is being accelerated by the pandemic. Between January and March 2020, health tech deals jumped by 76% from Q1 2019 to hit 8.2 billion, and that's a 25% increase in aggregate deal value when compared with Q4 2019 and the highest quarterly total on record. North America dominated deal activity with 56% of the deals activity based there. The largest venture-backed health tech deal completed in Q1 2020 was the 285 million Series E financing, which was held by ClassPass, which earned the New York-based startup a valuation of 1 billion and therefore unicorn status. Just behind ClassPass was the 250 million Series D financing for ScriptDash, a San Francisco-based digital pharmacy that trades under the brand name Alto. It was founded in 2015, and the startup operates a web and mobile platform enabling patients to do things like request refills, schedule the delivery of medications, or message pharmacists via their digital device. I think these deals underscore the growing investor appetite for consumer-focused, personalised, digitally accessible health and wellness solutions. Digital technology such as mobile internet is increasingly being deployed to provide consumers with fast, easy ways to look after their health. Currently, health tech deal value sits at 3.2 billion and is on course to exceed the 2019 quarterly average of 4.8 billion. I also just want to cover how operations have been affected within GP firms as well. So obviously with the effects COVID has had on fundraising and deal making activity. So obviously what effect is this having on the day-to-day operations of GPs? So in April, we surveyed fund managers to ask about how their operations have been impacted. Unsurprisingly, the main areas of impact have been the ability to fundraise from investors, deal origination, and the restrictions placed on portfolio company operations. However, some areas have been impacted less, and it's encouraging to see GPs doubling down on their IR with existing investors as they seek to help their LPs navigate through the disruption. In terms of when GPs expect operations to return to pre-COVID status, 74% believe this will happen within 12 months, including 40% who think it will be within 6 months' time. However, a quarter think recovery will actually take much longer than this. As well as GPs, we also looked at LPs to gauge their sentiment, considering the impact of COVID-19 as well. I mentioned earlier that LPs came into 2020 full of confidence and planning to put increasing levels of capital to work across alternatives this year. Investors understandably have become a lot more wary, and many LPs have revised those plans. As you can see here, 60% of investors surveyed will now decrease the planned amount of capital they will commit to new funds over the course of 2020, while 59% plan to reduce the total number of commitments they make. We've also been working with our partners at risk management firm FRG to create a forecasting model that analyses the impact of a recession on capital calls, distributions, and net cash flows. I appreciate that this chart may look a little busy, but it effectively compares a pandemic scenario against baseline numbers for 2017 and 2019 vintage funds. We focused our analysis on these vintages because they account for around 72% of the callable capital currently available across the private capital industry. The model suggests GPs will respond to COVID-19 by reducing capital calls and distributions in H1 2020, generating a net positive cash flow in H2, and then accelerate calls and distributions in the latter part of 2021 as the economy rebounds. It's also worth looking back at what occurred following the global financial crisis as an indicator of what might be to come. Now, obviously, there are a number of caveats here because the two situations are very different. But having said that, the GFC remains the best and most recent benchmark we have for a significant market downturn. This is an index chart which shows the percentage changes in fundraising for European buyout and private capital as a whole. Interestingly, both bottomed out in 2010 as fundraising fell to its lowest point, while private capital, which includes VC, is now back to pre-crisis levels. And it didn't fully recover until a full 5 years after the crash. Again, the two situations are very different, and the consensus is that we will see a quicker recovery this time around, but it's still interesting to compare. So just to summarise them, some key takeaways. I think the venture capital industry has been going through a period of extremely strong growth. Venture capital assets under management stand at 1 trillion, and we are coming off the back of essentially the third consecutive 100 billion fundraising year in VC. And performance has been largely meeting and exceeding investor expectations. However, while many were forecasting a market correction sometime soon, few could have predicted such a sharp and sudden end to the bull run as brought about by COVID-19. And as a result, 2020 looks set to be a challenging year as both investors and fund managers try to navigate the difficult times ahead. However, to finish on a more positive note, investors are certainly planning to stick with the programme. While investors told us in April that they are lowering their immediate commitment plans due to COVID-19, they retain longer-term confidence in the alternative asset classes. As you can see here, while GPs are admittedly a little more varied in their views, 92% of the investors we surveyed will continue to invest either the same amount or more capital in alternatives beyond 2020. And why is that? Well, the performance of the asset class speaks for itself. Private equity and private capital more generally has consistently outperformed the public markets over the years. It has proven to be better at preserving capital, and it continues to offer investors the diversification benefits that they seek. Well, that's it from me. Hopefully that's been an interesting overview and has set the scene nicely. Obviously, if anyone has any questions about the deck, my details are on the screen now, and I'll be very happy to respond to any questions you might have. But thank you very much, and I hope you enjoy the rest of the event.
Great, thank you, Thomas. And just to check, the slides are available for people if they ask for them then, are they?
They are, yes.
Okay, great, because there's a lot of great data there. There's actually so much data, some of it confused me, so I just want to clarify a few things if I can. Sure. You seem to be saying that the venture capital market fundraising for venture capital was doing really well in the past quarter, whereas for private equity generally it was doing really badly. Is that really right?
In terms of fundraising?
Yeah, in terms of fundraising.
Yeah, I think from the data that we're seeing, we are seeing substantial growth at the moment in venture capital. I think there's a lot of opportunity out there in the market, and I think there's been some well-publicised success stories with venture capital, and I think that's drawing more and more LPs into the space. And I think performance, particularly within early stage investments, has been particularly attractive to LPs.
So you mean it remains attractive rather than actually this data is lagging because it takes people a long time to raise funds and report. So, you know, if I was going to be cynical, I'd say it's just a lagging thing and fundraising will decline. Or am I wrong?
I mean, it's difficult to say now that we've been hit with obviously the pandemic. I think fundraising will be sort of all over the place for the moment, but
okay.
I think the asset class remains attractive, and I think it will continue to draw investors.
Great. Well, that's great news for our panel, I think. so I'm going to turn to the panel now, and I'm really pleased to have you all. It's a great panel. I'm not going to introduce you. I'm going to ask you to introduce yourselves and to get us talking. So Cansu, maybe you could kick off with a very brief introduction of both yourself and your firm.
Sure. Thank you, Patrick, and thank you, Thomas, for the really interesting presentation. So hi again, everyone. This is Cansu. I'm a senior partner at Bethnal Green Ventures. We are Europe's leading early-stage tech for good VC. And at the fund, I mainly look after our fundraising, actually. At BGV, we tend to focus on the very early end of the funnel, and we invest in tech for good ventures across 3 main impact themes: a sustainable planet, healthier lives, and a better society. We've been doing this since 2012, so I quite like to joke and say we've been doing it before it was cool, really. And we've so far invested in 127 startups. 73 of them are still active, and as a small way of communicating their and by extension our impact, we tend to map them across UN Sustainable Development Goals. There's 17 of them, and so far our portfolio covers 15 of SDGs.
Very good. And Markus, maybe you could go next. I know you have a very different perspective and background.
Yeah, hi, my name is Markus Solibieda. I'm with Bsf Venture Capital. So as a corporate venture capital organization, we are in the market since 2001. We have a global approach where we invest out of our German headquarters for Europe. We also have a presence in the United States, China, and Israel. So we take a global approach. Mostly we are investing from seed to later stage, focused on Series A, and we like business models, new business models in and around the chemical industry. Of course, that's where BASF has its roots, and where we try to understand the impact of digitalization, how that can how we can build new business models, new opportunities, partnering with the most interesting startups in the market, and take away also strategic insights for our organization while being a successful venture capitalist at the same time.
Thank you. And Michael, last but not least, would you like to introduce yourself?
Absolutely. Thank you, Patrick. So my name is Michael Szalontay. I'm the managing partner of Flashpoint Venture Capital. We are a Series A specialist venture capital firm. We support founders from Central and Eastern Europe, defined very broadly. So this also encompasses Israel and all countries that are in the Commonwealth of Independent States. We invest into companies that have a proven product market fit. So basically for us, this means that they have already reached annual revenues of about $1 million or euros. And we specialize in software. So we do both B2C and B2B software. But it's very important for us that the company is first and foremost focused on a software technology.
Okay, great. And you have a particularly nice looking background there. Is that real? Where are you?
Yes, it is. I am actually in a beautiful shop with antique lamps. Well, so that's the background.
Well, and it does look lovely. But
thank you.
I'm going to start off with you, Michael. Do you see the same picture Thomas painted then of venture capital remaining pretty bubbly almost in spite of COVID? I must say I don't entirely recognize it myself, which is why I'm asking.
Yes, it's actually very interesting because the picture that Thomas painted is quite sort of, well, similar the way we see the world sort of from the ground up. Life has almost halted at the end of March, sort of beginning of April. We were actually scheduled to close our next fund in early April. And obviously, a lot of our LPs were in the process of signing documents, going through KYC, and life has literally stopped. So we had to delay the process. But starting sort of basically from mid-May, things have picked up.
Wow.
And we've now rescheduled the closing to July. And it seems that we should be able to pull it off and close sort of round about the same number that we were planning for April, which is amazing.
Fantastic.
I think this is driven by a number of factors. First of all, the stock markets have rebounded, and specifically the tech sector has been very resilient. And you know, within sort of VC, we're in the software space. And I mean, if you look at our portfolio, we see that we have probably a quarter of our portfolio which has been negatively impacted by COVID, specifically companies which are around travel, leisure, hospitality, but also we have roughly 50% of our portfolio which has been positively impacted, specifically industries like online education, online entertainment, also remote work, and a lot of the B2B software as a service tools specifically have been aimed at enabling remote work. I'm sure that everyone has seen Zoom's stock price skyrocket. Right, and this is a general trend, and I think people appreciate that the habits of everyone will change, and many of these new habits will stick. And so I think investors realize that in the next cycle, in the next 10 years, software will continue to eat the world, as they say, and especially, you know, software which is looking at remote work, remote entertainment, online education, healthcare that was mentioned. So in that sense, we see the markets picking back up. I mean, we ourselves as a manager, we've closed our first post-COVID transaction at the very end of April, investing into an online education company. And we've closed 3 more deals early June. So we're very active. And we believe that for software specifically, this crisis is going to be a blessing eventually, because you know, people will realize that this is the end for the old economy, for sure. You can't operate in 2020 and beyond without being able to work remotely and without being able to sell and service your customers remotely.
Okay, so if you're in the right place, this is looking pretty good then.
Correct. Right time, right place.
But Cansu, you do tech for good, right? And that sounds like a pretty good place. But you're doing very early stage, so you know, I guess most of your companies don't yet have customers. Are you impacted at all by this?
I mean, I would echo some of the stuff that has already been said, I guess. So first of all, it's important to recognize the situation we're in, right? It's a global crisis. The issues we're all facing are really complex and cross-cutting. And then there's also our regular global crises, you know, climate, rapid urbanization, aging population, quality education. So these are all areas of massive human need that is coupled with relatively low exploitation of digital tech. And while I don't want to sound opportunistic in face of all the catastrophe that we are facing, I can't pretend that there is a massive investment opportunity here in tackling global issues. And even before COVID, we were actually seeing impact and diversity getting more and more like mainstream interest. So I guess in that sense, I have to say it, because we tend to invest in must-haves more than good-to-haves, then that we haven't seen an immediate negative impact in that sense. Like we still see more demand that we can meet at the early stage from the entrepreneurial side, and I think that's because as long as these problems, which are mainly systemic, are still there, there will necessarily be solutions popping up. So, and in terms of our own investment strategy, we normally invest in 20 pre-seed deals every year, and then have 7 to 12 follow-ons. We haven't dialed that down. We've already made our 10 investments this year, and we expect to actually make our next 10 offers completely virtually. Like we will have to do all the DD virtually before we make those offers. But I have to also underline that we're a very specific piece of the VC market, you know, purpose with profit. And I guess in terms of the fund and portfolio performance, some of our portfolio companies have proved more resilient than their similar counterparts. You know, health tech, remote tech, these are like the ones that have already been mentioned. But there's also the other adjacent industries. For example, our worker tech companies that work on basically helping low-wage workers having better lives. They're seeing a massive demand because they are addressing actually meaningful problems.
Okay, great. And so 2 optimists out of 2. This is pretty good going. Markus, you know, you have a more global perspective and from a more corporate background. And I'm going to keep sounding negative for a second, but my history says that corporate VCs just tend to shut up and go home during recession, right? Is this going to happen this time, or what's your perspective?
Well, I think your observation to some extent has been correct in the past. I think in the global financial crisis of 2008, 2009, there have been some corporate venture activities that have been shut down, actually. But I think if you look at the long-term trend, what is prevailing is the conviction that corporate venture capital is a crucial element of your, let's say, tool set in order to execute on corporate innovation. And just to give you one number, when Bsf Venture Capital was founded in 2001, so 19 years ago, we were, I think, number 7, the 7th corporate venture capital unit in Germany. Today, there are more than 120 corporate venture capital units of German corporates. So while there might have been also a kind of a cutback in the difficult years of the last financial crisis, I think the long-term trend is for sure is there. And of course, I'm happy that I'm able to report that our organization always was there in the last 19 years without interruption. Other players have done it differently. They came to the market and they pulled back and then came again. So we have this kind of permanent, let's say, presence in the market, which of course helps us, our brand and our relationship with the companies we are working with. So yes, and so I understand your concern, but I would say that the corporate venture capital scene today is much more stable than it was in the past, because it's no longer a nice to have where you allow yourself to do some corporate venture as to play around a little bit with testing some startups or their business models. But as I said before, today it's a very crucial element of your innovation strategy as a corporate. And so I think corporates are well advised to stick to their units also in the times of crisis. Yeah. And to finish on that, on Bsf Venture Capital, I must say we are receiving a very strong internal support. Currently, we of course address this issue, how we deal with the crisis, also with the board, and who is of course our LP that we have as a venture capitalist. And we got a very strong support, not only to continue to finance our existing portfolio, but also to continue to look at new deals. And actually, currently this month, we will be closing 2 deals in 1 month. So I think all good here on my side.
No, it's good to know. And
Patrick, if I may add something, and I think
go for it.
Thomas is the real expert here, but I think you know, the sort of the information on the street has always been that venture capital fund vintage years are the best vintage years are crisis years, or the years coming right after the crisis.
Coming
so
after, actually, probably.
Vintage then like 2009, right, were very good. So similarly, funds that will have a vintage of very late 2020 or sort of 2021 should do well. And obviously, The other thing is that VC is an extremely long-term game, right? It's a marathon. Out of all the other private investment classes, it's the one which has the longest investment horizon. You really, if you're participating here in any way, you really have to be prepared to do it for the long haul. And when a crisis comes, you have to be an optimist.
Yeah, well, I think nearly all venture capitalists are optimists. By the way, thank you for the questions that you're putting up, which I can read. And a number of them are showing concerns rather than excitement. They're talking about repricing deals, about the number of late-stage companies that are going to run out of money. Are you guys just not seeing this, or who would like to pick up this question? Is it a rough, tough world out there which you're just lucky to be avoiding?
I can speak from the pre-seed/seed angle, I guess. We've definitely seen, so obviously for us, the health of the early stage investment ecosystem is really, really important. And therefore angels make a really big part of that. And we've definitely seen some reluctance. So this is anecdotal. I don't think anyone has meaningful data to draw proper conclusions at this stage, but we've seen some of our portfolio companies where people postpone or dial down their commitment. But on the other hand, some tax-intensive funds are still closing. For example, in April, we closed our third SEIS fund. So there's mixed signals. Okay. And I think everyone is sort of slightly sitting on their hands as the situation plays out. And I would also expect that to reflect in our own fundraising capacity, right, because the same sort of thinking can be seen in the family offices, for example. And to your point, Patrick, I think I agree with that slightly cynical take on fundraising taking so long to convert or not convert that we don't really know where we are at the moment.
Yeah. So what are you telling the CEOs of your portfolio companies? What advice are you giving them then in these circumstances?
So I guess when the situation was first playing out, we and our portfolio companies were in an advantageous position that a good chunk of the ones that were fundraising, and we usually have roughly 15 companies fundraising at a given quarter. Wow. They had just closed deals in January and February. So those were the lucky ones, obviously. For the ones that are already in the process, sorry, I don't know if you can still hear me.
Yep.
Okay, great. I got a little error.
Yeah. We can still hear you, yeah.
Sorry, I'll turn off my video just to be on the safe side. So for the ones that were in the process, obviously the first advice was close as soon as you can. And some were able to do that, some weren't. We've had instances where we felt some of the investors were quite predatory in trying to slash down valuations. The advice in that sort of situations is this someone you want to have a long-term relationship with? Do you want to you don't have to take this money if it feels like toxic money, if you are able to do so. And I guess we've also tried to point them towards different support initiatives, particularly government-funded ones. I have to say, I'm only familiar with the UK ones, and for the very early stage, there hasn't been something that's widely meaningful to date. But we definitely try and encourage them to look into, not only investment, but grants or even procurement opportunities where they might be able to generate some quick cash flow if they're at a stage that they're able to do so.
So much more focus on cash.
Yeah, exactly. Yeah. And finally, Patrick, we've also try and link different portfolio founders to each other, and we see massive benefits in that. So I'm pretty sure almost everyone does that, but if you don't do that, I would really encourage everyone to sort of connect portfolio founders going through similar issues.
Yeah. And Markus, sorry, Michael, carry on then. Dive in, and then Markus, I'll come to you.
To add to that. So first of all, cash is very important. So we've advised all of our CEOs and founders to basically prepare themselves and their business to have enough cash to last until the end of 2021. so for the next 18 to 21 months, because we believe the fundraising environment is going to be very difficult. And the second point is, I think it's very different for companies who are COVID positive or COVID negative, right? So if you're in health tech or if you're in online education, then obviously sort of it's an opportunity to grab market share. And we've advised all of those companies to go and aggressively fundraise. And we've definitely seen sort of investors respond and valuations unadjusted. Whereas people who are in COVID negative businesses, specifically around travel or hospitality, where the underlying business contracted, we've really sort of advised them to basically stay put for the next 6-9 months and wait for a recovery so that they have something to show before they go to fundraise.
Right. But are you saying then that the beneficiaries, to call it crudely that, are holding valuations, and those hit badly are in trouble? Is it as simple as that?
Unfortunately,
okay.
Yes.
Okay, and Markus, to bring you in on this, what's the best bit of advice you've given, or maybe even heard, for CEOs?
Well, I think right now it's all about transparency, and although it's very difficult times, but I mean, sometimes it might be the best advice or the best statement for a CEO if he's asked, where's your business going, that he honestly says, well, I don't know for the time being, but then make it clear what pieces of information he or she will need in order to get this clarity on the next months, on the next steps of the business model. I think it's when we talk to our portfolio companies, we of course we asked about the short-term effects of the Corona crisis on the one hand, and but we also at the same time we started to engage in a discussion about how potential long-term impact of this crisis could be on the separate business. And if you engage in that discussion, and if you're able to communicate what you're doing short-term, what is your impact, but also what you expect to be the long-term impacts, and even if it's just good guessing, but it should always be proactively communicated, and don't position yourself as a victim of the crisis, but position yourself as an entrepreneur who will deal with the situation, who is transparent towards his shareholders, and who has a plan.
Yeah, no, so that sounds like very good advice to me. But so I'm supposing I'm a CEO and I do all that, and I honestly, there's a wide range of scenarios for my business, and I'm asking you for money. How do you take decisions with such wide-ranging uncertainty, or do you just defer them all?
Well, it's I can take that again. It's really different because so far venture capital, or usually venture capital, like any investment business, is about risk assessment. So how likely is a business to succeed? What are potential risks that could interfere, competitors, market development, and so on. So and then you would do your modeling. You would do the math and say, okay, this is worth trying, and another one might not be worth trying. But here now, as you said, it's not just about modeling risk, but it's also another element is the uncertainty, where many you would just do your math in the past are now no longer possible, and so that's what stopped also some people also to defend some of the slow investors you might have seen in the past 2 months. These people were not willing to take risk, but they were just in a situation of which of course forced them add another variable equation, and that takes time to have this new, let's say, working mode where you're not just a risk manager, but also somebody who is taking severe or important decisions under
Michael,
a very high level of uncertainty.
Are there any kind of indicators you look for to give a sense of, a new normal occurring?
Well, to put it very crudely, let's go back to the end of March, right? And whenever we were looking at businesses at the end of March, even the businesses where we were already investors, it was impossible to predict revenues for April, because it was very clear that, we were hit by a bus, but how severe the injuries are was not very clear. But by the end of April, beginning of May, the picture became more clear. It became very clear if clients are churning, if clients are not churning. It became very clear what's happening to the marketing channels of various businesses, right? If they're still capable of scoring new clients and new business in the new circumstances. And, for some businesses, if they're capable to accelerate growth because of what's happening. And that's why sort of early May was the time when we were really ready to resume investment activity, because many of these risk factors that Markus has mentioned have cleared up. At least you had enough data to take some view.
Right.
I mean, if you think about VC in general, we all take a lot of risk, right? We're just trying to take risk with which we're comfortable. And since each and every VC is different, we take different kinds of risk. But I think the picture by early May, the picture has cleared enough that most of us have resumed investment activity. And we speak with a lot of VCs. I mean, we're not generally a lead investor, but VC is team play. You always invest with other people into deals. We almost never do deals alone. And we see that our usual friends, with whom we do deals regularly, they're all back to investing. They're all back to giving out term sheets. And I think it's down to the same things. The impact on most businesses, at least the medium-term impact of the crisis, is clear.
So that's good to know. And Cansu, how do you get back to business normally? When I'm not sure anyone's in the office on this call, right? I can't see an office background. So how does it work? Can you actually meet CEOs?
So in terms of meeting people, we already have a quite established process, because the way we invest is always through our Tech for Good program. So the very first offer we make is a one-size-fits-all offer. So for that, we already have online systems that we've been using for quite a while. And as we were trying to decide on the first 10 investments of this year, we were lucky that the in-person interviews were just before the lockdown. So we were able to do that. But then what we had to do is we completely took everything online. So we finalized this is actually the 12th week. So we're finalizing our 3-week Tech for Good program. 3-month Tech for Good program this week. And for the next stage, what we're going to do is we're moving all of our interview stage online. So normally what we do is we roughly get 250 applicants. From there, we have 40 interviews and make 8 to 12 offers. So what we will just be doing a lot of Zoom calls. But I also have to underline, everyone, I guess, we all do risk assessment, but because we are going in so early stage, usually pre-revenue, post-MEP, I do think that we have a slightly higher risk appetite than maybe the others on this call.
Well, this is fascinating to me, because it sounds like you're living off your knowledge bank of people you've met before at the moment, and you're just deciding how you might take a view on people you can't physically meet. Is that right?
In a way, yes, but I guess this comes down to the the vertical that we operate in, because we've had to take an ecosystem builder sort of role as well. This sort of community building, working with others, making sure that we sort of help our deal flow grow is very familiar ground for us.
Sure, but early stage, you're backing people more than plans, and so you're gonna take a view on people remotely then.
Yeah. I mean, I guess we feel comfortable in our processes enough that we feel like there might be room for error, of course, but I think it will be, tolerable.
Okay, and so Markus, would you do that? Would you back someone you've never met physically and rely on Zoom or equivalents?
That's a very interesting question. Actually, just very recently, for the first time I hired a person that I haven't met physically before, and so I had this discussion. I had this discussion also with our HR people and friends, and who said, well, was it a problem, or was it even helpful not to meet that person physically? So actually it could make the process more objective. If you meet this person and you find he's the fan of the same soccer club like you are, can have this kind of relaxed personal conversation. Is that helpful for your hiring process, that you become subjective in your decision making? Probably not. So if of course you're forced to do it online in a very objective manner, you pull in other people to look at the candidate, to discuss certain strengths, weaknesses, experience, and so on. So you try to make it as objective as possible, while I would doubt that a personal interview always is as objective as possible. So I would say there's even some improvement in this process. And so if I take that to an investment decision, actually, to be honest, I think, yes, I would expect that still in 2020, we will make our first investment in a company where we actually haven't physically met the team.
Right. That's fascinating. I guess you almost have to, otherwise you're going to cease to do new business.
I would like to take a contrarian view.
Yeah, good, because you should be driven by data. B2B software, the world's full of data and metrics, right?
Data is important, but I believe that also investment in industry is built on trust, right? And trust is built on honesty. And I think, people say that 90% of communication is nonverbal, right? So it's actually very difficult to really grasp a person and understand how honest he is. Partnership, I mean, in most businesses, we are, in all our investments, we are sort of minorities, right? We're mostly on the board of a company in most businesses, but sometimes even not on the board. And so, it's all about trust. And I think it's extremely difficult to size up a person and understand how he will behave in a crisis situation. Because when all is good, of course, everything is great, right? But you really have to try to foresee what if things go not as good, or if there is a conflict.
Okay, but I kind of agree with you. But you're saying, though, just to make it difficult, that you're going to see new opportunities. Actually, the world's going digital. You're doing more business, but yet you can't physically meet people maybe as you want to because you can't travel. So
I think for us, it will be important to keep traveling. So we're very much looking forward to, we have 7 offices across Central and Eastern Europe, right? And we have a lot of people on the ground meeting with entrepreneurs and sort of, hopefully physical meetings, we will be able to resume them soon. I mean, in some countries, you're already able to meet observing social distancing measures. So we believe that is paramount. For businesses themselves, I think it's different. So I really believe in businesses which work remotely. I mean, even we ourselves, we have 7 offices for, 18 people. So it's completely possible to work remotely. But I think when you invest, and there's still some things which still require, old-fashioned ways of doing business. And it might be strange that I, as a VC, and we're super tech-oriented. We have a lot of technology that helps us gather data, do sourcing, but still, there is this sort of trust element, which I think is very difficult to overcome over Zoom.
Yeah.
Patrick, I want to add to that, and I guess there's one thing to keep in mind, though, like as we are sort of shortening the distances by going remote, we're also opening our doors up to a more diverse founder group. because not like I feel like this remote situation that everyone found themselves in has made it slightly easier for founders that come from, not the usual suspect sort of backgrounds. So I actually, and I know most of my colleagues will agree, we see an opportunity to connect with people that maybe we wouldn't be able to connect with otherwise. And at BGV, we make a conscious effort to not to go through the warm intro route as well. So I feel like that's pertinent to mention it. Oh,
okay. It's kind of fascinating to me. It sounds like you're all actually adapting very fast. Do you think the rules of what makes a good business are going to change then? And I'm happy whoever wants to pick this one up.
They have already changed. First of all, as I said, I think if you're not able to sell and service your customers remotely, you're not in a good business. And
so the real world is dead, right? That's what you're saying, and it's all virtual now.
Well, it's sort of not completely dead, but definitely its importance is going to wane. People say that seminal crises bring 40% of new companies into the FTSE 500, right? And I think this crisis might bring not 40%, but 60 or 70% of new companies into the FTSE 500, right? So in the next 10 years, we will see a lot of companies completely changing their ways, and whoever will not be able to adapt will stay behind.
Gosh, I'm spoiled for choice now, Markus, Cansu, who to ask, but Cansu, I'm going to go to you first and then to you, Markus, on this, because do you think some of those new entrants are going to be purpose-driven companies then? Tech for good companies? Or because this is clearly a rising trend now.
I mean, I'm contractually obliged to say yes. But joking aside, I sincerely believe that we are at this stage where we investment community need to move beyond ESG and more meaningful measures. I don't think that as a planet we are running out of options to keep the habitat livable. And it's not only enough to not invest in bad. We need to actively invest in good solutions, inclusive solutions as well. And to sort of follow on from the diversity point, there's so many studies that talk about how diverse founding teams build better products and provide better returns to investors. These are we are at the stage where there's enough financial data that it makes it feasible for even mainstream investors and asset managers to look into impact even more seriously.
Okay, good, great. So Markus, you've got a double challenge now, right? So you've heard from Michael that if you're not digital, you're dead. So you're a chemicals company, and you've heard from Cansu that if you've got to be very, very kind of green and ethical. So sorry to put you on the spot.
Yeah, but actually, I believe that technology and also part of it will be pure hard science. Eventually, will be also the solution to the problems, to the climate problems, the environmental problems that we have today. So I'm extremely optimistic, looking at the efforts of science and the efforts of young companies in that space, and the kind of impact they can have, and so yeah, I'm a great optimist here, but of course it requires lots of resources to get it started.
Right. You have the resources, I guess, as a big company, but do you recognize the picture of far more rapid change that's being painted of, the leap forward in the digital world, the leap forward in environmental concerns? Is this?
Yeah, I mean, to give you one example from our investment space, which is digital farming, and so now with digital tools. You can, using drones and satellite images, you can come up with in-field diagnostics if you want to deal with pesticides, for example, in a soy field. You can exactly plan where you you want and where you actually have to spray these herbicides. And as a result, you might today, if you apply these digital tools correctly, you can save 70–80% of the herbicides that you that a farmer used to apply in the past. Of course, you at first sight you say, well, this is bad news for BASF. But of course, that's why we are there as venture capitalists. We want to capture the opportunity of that new business model of delivering a service. And so it's a combination of this, let's say, digital opportunity that is given to us and with artificial intelligence, data processing, software solutions that are there today, and combine that with our resources, we have the access to the customers who require these kind of solutions. And again, this makes me very optimistic that that these are very exciting times and the right times to make major leaps forwards, also in terms of tackling the big problems of our planet.
Okay, no, very good answer. Very encouraging to hear. Thank you. I want to turn the questions now a little bit towards how you're seeing your portfolio companies react, because I've kind of heard that if you're in the right place, things are going well. That's great if you happen to be in the right place, but if you're in the wrong place, life is tough. So I'd like to hear any examples you've got about companies that have managed to pivot or change and reacted well with good outcome in the face of crisis. And to give you an illustration, one of our portfolio companies, which I look after, a company called Zelo, it runs digital bus services for transport deserts in the UK, serving big companies. And frankly, their revenue collapsed in the first week of lockdown, and things looked pretty terrible for a while. But the guys are great entrepreneurs, and not only did they cut costs, but they also moved towards realizing that they could offer safe transportation for critical workers and other people who just needed to get to work but needed safety, and their business has been booming since. So have you got other examples that you can share of companies that have had to adapt and are adapting successfully?
I guess we have quite a few, both that were already well positioned to be able to benefit, in air quotes, from the crisis, and also some that have quickly adapted and sort of started providing solutions. So there's a couple of usual suspects in terms of, we have quite a few digital health startups in our portfolio. There's one called Hospify, which is a GDPR compliant messaging app for NHS, and obviously they've seen a surge in demand. So did Doctor, again used by various NHS trusts for appointment scheduling, remote appointments. Then we've seen our mental health and support startups getting more both B2B and B2C demand. I can mention Talk Life in there. I've already talked about Organize, which is around collective action and worker rights. They've doubled their user base in just 2 months since the crisis started. We have startups that work around food security and biodiversity. So, for example, Let Us Grow. They are an patented aerophonic solution hardware and software company, and they were actually able to provide some emergency greens. They're based in Bristol, by using their own, R&D labs, which I think was a really sweet gesture. And finally, we have Commonplace, which is a platform for local authorities and developers to be able to communicate with local residents. They've been quite active in making sure that local authorities were able to communicate the rapid changes as the restrictions were put upon the population.
Okay, and Michael, have you seen any major changes in your companies as they've reacted?
Yes, definitely. So I'll mention a couple of examples which amazed myself. We have a company called MarketMan in our portfolio. They basically automate sourcing of ingredients for kitchens of restaurants. So they have been severely hit, as obviously all of the restaurants have been shut down during the lockdowns in various countries. And, you know, they are a software as a service business working on a subscription model. You know, they have amazing cohorts. So basically restaurants never leave their platform once they come on, but suddenly people were in a situation when they had zero revenues, right?
Yeah.
So the guys basically came up with quite a cunning idea. They offered people to stay on, and while their restaurants are closed, basically they provide the same service for 20% of the original price. So this way they were able to keep basically 90 to 95% of their clientele. And now as restaurants are reopening, whenever a restaurant is reopening, basically they put them back on the original pricing schedule. So I thought that is a very creative sort of a solution to their problem. Well, obviously they lost a couple of months revenue, but importantly, they kept their clients.
Yeah.
And they've supported their clients in this crisis. Sort of maybe making a step back and looking at the problem sort of for a more helicopter view perspective, I think, you know, businesses which have been directly hit, like people who are in the travel sector, for example, we had a couple of companies like that, for example, Yesti in Israel, which are in the short-term rental, apartment rental space. So they automate the work of property managers who use Airbnb and Booking.com. And obviously, again, due to lockdowns and travel restrictions, you know, bookings froze at the end of March and April. So they had to lay off a lot of people in order to conserve cash. But I think what's important here, and what they were particularly good at, is that they made this decision very quickly.
Right.
And so they laid off a significant portion of their workforce. Partly these were layoffs, partly people were sent on unpaid leave, right, until the situation resolves itself. But I think the speed with which they acted was paramount, because, and I think, you know, you see founders clinging on to people, you see founders clinging on to ideas, and we like agile founders. We believe it's, you know, if you're an entrepreneur, it's very important that you're adaptive and that you're agile and that you respond quickly to the environment. We were very pleased that, you know, the founders at Yesti have been extremely quick to fix their burn. Right. And definitely they extended their runway by probably 6-9 months as a result of their actions. And, you know, now they have enough cash until like end of 21. And by then, hopefully the travel sector sort of picks back up.
Yeah, hopefully.
We also have a very interesting company called Dostavista in the delivery space, right? And they are basically an Uber-like marketplace connecting couriers on foot and small and medium businesses, sometimes large businesses, which, you know, need delivery. And it's a very interesting time for them for two reasons. First of all, everyone wants delivery. So they see a lot more demand in their marketplace from the small and medium enterprises to get stuff delivered to consumers. But equally, you know, these lockdowns are causing unemployment. And working as couriers is something that is very easy and obviously sort of a good source of temporary income. So what they've done, they went very aggressively after people who have been laid off in the past 2 months, offering them to join their platform. And they operate in 11 countries. Quite a lot of their countries are in Southeast Asia. And they've seen an enormous jump in some of their markets. So in some markets, they've seen jumps of like 5 to 7x in 2 months, driven specifically by the fact that, you know, I mean, we're all reading the same newspapers about macro indicators, right? And we are all seeing record number of unemployment across the globe. And clearly, they are one of the ways for people to gain temporary work. So, you know, they've been very innovative in finding ways to market to these people and basically try to get them on their platform. And also, on the other end, you know, to help people deliver, which is now important.
No, fantastic. Thank you. And Markus, are you seeing similar examples of, I guess, agility, creativity, speed?
Yeah. We have seen many unexpected developments in our case. 3D printing is a good example, where first we had to suffer from interrupted supply chains. Some parts of our 3D print manufacturing coming from Asia, so they were struggling. Customer side, there was that were simply not targeted in the past. So for example, we have two 3D printing in Berlin, one in Texas. They both started to print, or they also to print face masks when they were still very rare and popular.
Markus, we're beginning
of parts in a time when global supply chains were interrupted, and that interestingly
you're cutting out on me a bit,
just
so
a short.
you might want to try just going off video. I can hear you now. Maybe you could just repeat what you said. I didn't hear the last bit.
Is that better now?
Yeah, thank you.
Okay.
Yeah.
I was just. Is it better now? Yeah. How
it's not better.
3D printing companies were able to. Sorry.
Yeah, you're breaking up, so I'm going to be rude and
okay.
move on from you whilst you resolve that, and maybe you go off video. By the way, we're going to start picking up the Q&A in a few minutes' time. So for our audience, do start thinking about it. In the meantime, I want to ask each of my panelists for a key message that they would give people from all of this. Could be a reflection, it could be funny, it could be simply profound, or maybe just a prediction of what you think's most likely to be different. Cansu, if it's all right with you, I'll start with you, just to give me your takeaway.
Yeah, sure. I mean, I guess if I wanted people to leave with one message, that would be to invest in impact. I sincerely believe in the opportunity and the necessity of that. And on a little tangent, we haven't really talked about the potential role of government. I think it's really important to recognize how interconnected this whole ecosystem is, and how much real innovation really depends on government support. I'm pretty sure most people on this call will be familiar with Mazzucato's work around that, how big innovation, particularly in the States, was actually ignited by government subsidies around and support around R&D. I guess what I'm really trying to say is we are all private investors, but I think we can all go further if we were able to work with government authorities on making sure that the ecosystems that we operate in are as robust as possible in times of global disruption.
Oh, okay, and just to clarify, I'm very keen on impact investing myself, but are you saying people should do it just because it's the right thing to do?
No, no, not really. I don't think I think I'll be doing my job halfway if I said that. Okay. The funds are overperforming. The financial data is there. There is a massive opportunity. These are global markets. The global problems alongside with the massive human need. I do believe that we are at the stage where this is becoming mainstream, but it's not mainstream. So the early movers in the space will be reaping the most meaningful rewards quite in the midterm, I would say.
Very good, thank you. So Michael, you've had plenty of time to think now.
Yes, well, actually, what I wanted to say is that I think this is really a seminal crisis, and as all seminal crises, it's a massive opportunity for entrepreneurs, for investors. There's a famous quote from Thomas Edison, I believe, who said that opportunity is missed by most people because it is dressed in overalls and looks like work. So my message to everyone out there, don't shy away from opportunity. You need to do a lot of work, very, very hard work, but now is the time. And there will be plenty of opportunities for businesses, for people to start new businesses, and for investments as well. So don't shy away and do the work that is necessary to get there.
Fantastic. So Markus, can you hear me now? I think you're on mute, but if you're, there we go.
Yeah, is that?
No, we're still having some sound.
Is it? Can you hear me now?
Yeah. Okay, go for it.
Okay. Sorry. Yeah. So yeah, my take was that the way we work, the way we take decisions will definitely change. I think we will not go back to the old office world. We will not go back to the old personal meeting world. And I would recommend every startup to prepare for that scenario. And in the end, those startups who are able to deal with their clients in the new virtual world, those startups who are able to manage their employees in this new virtual mode, and in the end, those startups who will be able to raise money even in a virtual mode,
fantastic.
They will
Thank
be
you.
the most successful, in my view.
I think the idea now is I will take some questions, and there have been questions, good questions from a number of you. So do add to them if you would like. So I'm going to scan down the list now for a second, and if I can get it to work, it's now frozen on me. I mean, I'm going to take the most recent question to encourage some of you to put in new questions as well. So the question is about valuations being affected with so much uncertainty, and probably most of you had to value your investments on the 31st of March, which was a particularly bad time. How do you value things in such an uncertain world, existing and new investments?
Well, I may start. So, we've been actually in the middle of doing a deal at the end of March. Well, we delayed the deal due to the overall uncertainty by a month, but we closed it in the end of April. We didn't renegotiate the valuation.
You didn't change the price?
No, we felt it was not right because, we've agreed the price, we've agreed the deal terms, and we didn't feel that the business has been impacted. It wasn't a material adverse change for them.
Okay.
They were in the online education space, and it was probably even slightly net positive, the effect of the overall crisis on them, and we definitely didn't feel it justified in any event. I think overall, there are international private equity and venture capital valuation guidelines that govern the way we value portfolio companies for our investors. And they basically say that we need to use precedent transactions around the companies for 6 months, and then we need to use multiples and apply various liquidity discounts, minority discounts, and so on, because obviously the companies that we're investing into are not public. So you can't just take a public multiple and apply it to a portfolio company. But in general, now that the markets have gone back, I think looking at valuations holistically, looking at valuations at June 30, I think our portfolio in general would be unaffected. So we would still be relatively at the same place where we were at the end of last year.
Wow.
Right?
Oh, that's interesting. Yeah, very good. Thank you. I'm going to move on with some other questions. So Markus, if I turn to you, have your investment theses changed at all? You know, with stages, you're looking at different verticals and teams. You said the world's different now, right? Then your investment, the way what you want to invest is presumably different as well.
Not well. Yes, you want to be even more, let's say, digital, and
okay.
are not depending on, let's say, personal interaction with customers, who are not depending on, we are in the B2B space only, but then of course, if you have a software as a service business and you manage to reach your clients even without visiting them and doing, let's say, a physical, or having the need for a physical presence.
Oh, I think we have lost you again.
That remotely, if you are unaffected by travel. Sorry for that. I tried to improve my connection.
No worries. But I think you're basically saying that you are looking far more at digital business models as a result. So
yeah,
you know,
right.
Okay.
So
and Cansu, on a different question altogether, there is a question here about lessons learned from the global financial crisis. You know, is that really relevant, and what do you learn? I mean, I think actually the impression I have is that you're all very optimistic, but the lesson from the global financial crisis seemed to be it took 5 to 8 years for things to go back to normal.
I guess I can refer to BGV's history on that, because basically our origins lay in something called Social Innovation Camp, which was a grassroots group of people, highly talented people who were affected by the crisis and who wanted to use their talent in tech and policy to start building meaningful products. And reflecting the overall trend, our very first investments are some of our strongest ones. So, for example, Fairphone and Dr. they're both from that very first vintage. And I think the way I try and look at this, and this is more than anything to keep my own personal morale up within all this uncertainty, is to try and recognize the little pockets of opportunity. Is there, like, can we say that more talent is going to be available? Therefore, there will be better solutions down the line. Like, I choose to believe in that at the moment, because I know that will mean better deal flow for my fund, that will mean better hiring potential for my portfolio companies. So I guess I would try and draw conclusions in that sense. For anything else, I certainly don't think that we are at a stage where we can make meaningful guesstimations, particularly with the threat of a second wave looming above everyone.
Okay, and I think we're now coming towards the end of our allotted time, so there's probably time for just one more quick question, I think, before we reach the end of time. And there's quite a few people interested in the question of how you're supporting your portfolio companies through this period of uncertainty. So if each of you could just give one really good example of something that you've been doing to end our webinar.
I can go. I've already mentioned this, but I really want to highlight, because we've seen massive benefit from this. Like everyone else, we've tried to find some common themes among the portfolio as soon as the crisis was unfolding. So, you know, we've done the usual stuff, workshops, webinars, connecting to the mentor network or direct experts. But one thing that have proved very, very useful is basically putting people who are going through similar challenges together. And I have to say, we are very privileged in the sense that because we have so many companies, there's a really sizable group of very talented individuals that can help support each other. I feel like this sometimes this feels like soft support, but for for a time that's so mentally challenging, we shouldn't ignore the usefulness of that sort of approach.
Absolutely, the softest things can be the hardest things, right?
Yeah, absolutely.
Markus, I'm going to give you one more try here to see whether we can hear you now.
Can you hear me?
Yeah, perfect.
Okay, very good. No, I think although we claim that we are providing much more than just money to our startups, I think in this particular situation this year, what we did was rather unusual, that I presented to our board the financing need of all our startups in one go. So instead of presenting our let's say investment committee every quarter the required financing, I did it now in early May for the whole year, and we said these are the startups, 8 out of 25 active portfolio companies that will require financing in 2020, and so I was able to secure in one go financing for all of these startups, and so I think that's important. Now that referring or going back to your original question, how stable are corporate VCs, now being able to, for these startups to say, Bsf Venture Capital already have confirmed they will be there in our next financing round, I think that is extremely helpful for our startups.
Yeah, that's actually a great answer. Thank you. So Michael, what's your one?
The answer is the following: that in a situation like this, when there is a crisis, people need to be really close. They need to be together. They need to act in unison in order to address the situation. So we've actually held extraordinary board meetings in every company, and we've been in daily contact with all of the founders in every of our companies. We felt that they had to tackle a lot more issues than normal. They needed much more strategic advice, and sometimes, even psychological counseling, because, at times of uncertainty, when you're running a huge business and you're responsible for hundreds of employees, these are difficult times, and these people need support, emotional support, as much as decision-making support, right? So our job was to be there for them, and respond and try to help them.
Fantastic, thank you. It's a great comment on which to end. I think we're probably slightly over time, so I want to thank you, Cansu, Markus, Michael. Actually, I want to thank you as an audience as well. It's been really interesting. I've enjoyed it. I hope you have too. It's probably time for us to sign off. Thanks for listening and watching.
Thank you, everyone.
Okay, just to quickly sum up, thank you, Patrick, and thank to all the speakers for your valuable contributions. Just to sum up in 2 sentences, I think the panel and the whole discussion were mostly optimistic. I think all agree that the old world would change. Companies and also VC funds need to adapt, and we heard a number of examples of portfolio companies which handled the crisis pretty well. And like during every crisis, it is now also a great opportunity for new processes, business models, etc. So I think we can end at a positive note. And as mentioned, you will get the Preqin data in the email following the end of the discussion, and you will get also the link to watch the replay. So once again, thank you to all the panelists. We hope you enjoyed the webinar and hope to see you again soon. Stay safe and all the best. Bye.
Thank you, guys.
Bye-bye.
Bye.
Bye-bye. Bye-bye. Have a great day. Bye-bye.